Hello, I'm David Cariani and welcome to the RFA Weekly Market Update. And what a week it's been. Markets were all over the place with intraday swings of up to 5%. We have a bit of economic data to cover and earnings will be bypassed this week so we can take some time to dig into the bigger picture. But first, let's take a look at this week's ending market results. And I would like to note that our production was delayed today due to the extreme market volatility. We normally run these numbers midday on Friday, but today we did wait for the official market close. So these are the actual ending results for the week. It looks like the magic number for stocks was down 5%, with the S&P down just over 5%, and small and mid caps down 4.95%, and international stocks down 4.99%. And U.S. government bond yields only up a basis point. Normally you'd see those yields dropping as bond prices surge in a flight to quality in down markets like this, but this market was caused by a rise in interest rates, keeping investors away from bonds at this time. And mortgage rates driven by that 10-year bond were also little changed on the week. The dollar, highly correlated to interest rates, was up 1.33%, and crude oil tumbling over 9% this week. So let's take a deeper look at what's going on behind the scenes with oil. Here we're looking at a 5-year graph of global supply and demand for oil, and you can see the last couple quarters we've had demand above supply, causing that increase in price up above $60 a barrel. But you can see from the dotted yellow trend line, this is delayed data, be aware. So we are expecting that the actual data now has supply outpacing demand, causing the sharp drop in oil. And this is because the more attractive pricing has brought U.S. frackers back online. And in a brief update on economic data, we had weekly jobless claims down a bit to 221,000. And then we had national jobs report for the month of December showing a slight downtick in job openings to 5.8 million. And now we're not going to look at any company specifically, but we are going to check back in on earnings season as a gauge for the health of the economy. What we're looking at here again is the surprise in sales and earnings of companies that have reported thus far. And there are 341 out of the S&P 500 companies that have reported, with an average surprise on sales of 1.24% above expectations, with the leader being materials sector with 2.15% above expectations, an indication of inflation based on commodities from that sector. And then we have surprise on earnings averaging 4.77% above expectations, with the biggest surprise coming from the consumer discretionary sector, up 12.33% above estimates. And now a bigger indicator of economic health is this slide, which shows sales and earnings growth relative to the same quarter a year ago. We can see that the average growth in sales across the whole S&P 500 is over 8%, and the average growth in earnings is a staggering 15.74%, and that is without the benefit of tax decreases that will enhance earnings in 2018. And now let's take a closer look at interest rates, one of the drivers of all this market fuss. So we're looking at a little over a year on the US 10-year government bond yields going back to the end of 2016. The line indicates where it closed at the end of 2017 at about 2.4% yield, almost identical to where it closed a year earlier. But this year you can see a significant rise in the first month or so to 2.85%, almost a 0.5% increase. And that's due to the market building in the fact that it now expects the Fed will raise rates 3 times, 3/4 points, as they've always indicated, but now the market is actually accepting that as they are seeing signs of inflation picking up. And as these increased rates, that could dampen the economy over time, but we do need to realize that these are still accommodative rates and low from a historical perspective. And now let's take a closer look at the big market move this week. Here we have a graph of the S&P 500 from the beginning of 2017 and the big climb we had since then. We have officially corrected on the S&P 500 with a 10% drop from the high. The high was achieved on January 26th, and yesterday at the close of the market, The S&P was down 10.16% from that high, officially designated as a correction. Today we picked up about 1.5% back, leaving us where the red line is, showing that even after that sharp 10% drop, because we had such significant and unexpected gains in January, we're only down about 2% year to date, and we've only retraced back to late November, so we've lost about 2.5 months worth of gains, even after such a severe correction. And now let's take a look at some more fundamentals behind the market with this slide of the 28-year history of the forward PE for the S&P 500. So you can see on this graph, the red line shows the average over this time period. The average forward PE for the S&P 500 is about 17.1 times earnings. This hit a peak in the dot-com bubble of about 27 times earnings and a low point in the financial crisis of about 10 times earnings. But with the correction, we now stand currently below that 17 times number at a very modest PE forward. If the market does nothing but go sideways this year, we will actually earn that PE, and instead of being a forward PE, that will be our actual PE, indicating a very reasonable valuation for the market. And next week we'll get inflation readings for the month of January, which market participants will be watching closely as they are one of the main drivers of the Fed's rate policy and will dictate the pace of rate increases. We also have a handful of portfolio companies reporting earnings, but that's it for now. Thanks for watching. We hope you can join us again next week.